Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar index found a little bit of support on that 50-day moving average. We got a bottoming hammer right there, and chances are we might be able to bounce off that 50-day moving average depending on market behavior. Right now we're getting very close towards the end of January. It's January 20th right now, and my exit target date sits at around January 30 to 31st. So I'm pretty sure everybody is locking in a similar time frame on their calendars and are going to liquidate a lot of their assets going in towards the end of the month. Also, I do want to point out that the Italian government 10-year bonds did fall. Their interest rates did fall a little bit, which is pretty good. Some bond speculators were able to earn a bit of a premium on their investment, but again, I anticipate that to unwind pretty soon. Perhaps it will go all the way down to 6%, but that's yet to be seen. So we're just going to wait and watch and see how everything plays out for that Italian 10-year bond. Dow Jones Industrial Average is able to continue a little higher, clock a little bit of more gains. But the main reason we have this conflict where the Dow was barely able to get any gains was primarily due to the fact that the US dollar index was able to bounce off that 50-day moving average and clock a little gains. But what gave this market a little bit of confidence is the falling yields in the European bond markets, and that implies confidence, and confidence is good for higher risk assets apparently. So again, it's just a 1-month rally. We'll see where it takes us. It's yet to be seen whether or not this is going to be a multi-year rally. Most technical analysts aren't convinced, and we're just going to have to wait and see. Let's draw in some multi-year trend lines and see if it's going to lead anywhere. And no, I mean, based on what I'm saying, this should be near the top of the market. And if we're able to continue going higher, there's a good chance that it might be able to break out of this multi-year channel. So we'll just have to wait and see, and see how everything's going. But at this point, I wouldn't push it, and I really wouldn't go into this market any further. And the main reason why I say this is because the channel is there for a reason. The main point is markets like to push up into it, and they like to pull back a little bit from it as well. So until we can confirm above this for a whole week, I'm not yet convinced that this is going to be a multi-year rally in the stock market. And if I were to wait a week, that would basically be at the end of January, where all the dump is going to set in for the earnings season. So we're just going to wait and see if we can actually break out of this trend line. If not, don't be surprised, because again, there's not enough risk appetite in this market. I do want to point out that there's very little volume in the Dow component indexes, as you can see at the very bottom of the chart. We're sitting at around 150 million, in volume. So it's not much volume, and that's kind of good for markets because they like to float up on low volume. And whenever you see a lot of volume, either it's going to be a really strong up day, or it's going to be really, really rapid days, or a really, really rapid move to the downside. So we'll just have to wait and see how the markets play out. Moving on. Euro US dollar has finally pulled back a little bit, and again, the main reason why is because we're kind of running into that 1.3 area, which is a psychological area. A lot of people are pulling back, but I think the main reason why is kind of more on the European Japanese yen chart. We got close to 100. We tried breaking above it. We pulled back. I guess there wasn't enough enthusiasm from the bulls to try and break out of that really strong resistance area, because 100 is a very flat key number, and basically the moment you close below 100 is where I was like, okay, chances are we're going to go a lot lower. We're still in a multi-year downtrend on the European Japanese yen. Nothing has been solved from the European crisis quite yet. I haven't seen governments post a budget surplus. So until we see budget surpluses and the debt actually managed in reality, not on paper, but reality, because what we care about in the markets is reality. Until we see reality play out, where they actually do have budget surpluses, chances are the European Japanese yen will continue on this longer-term downtrend. Okay, now let's move on to the next chart, which is the gold chart. Gold is having a hard time staging a rally above that 200-day moving average, which is bad. You typically don't like watching markets consolidate below a 200-day moving average. A lot of different people will differ or disagree. Well, well, if the slow stochastics is embedded and it's above 70, everything's okay, right? The answer is no. It's not okay. The main reason why it's not okay is because you're still below that major resistance area. And until you're floating above that 200-day moving average and treating it like support, as far as I'm concerned, the market has a high probability of pulling back and going within these trend lines. So, again, the way I measure markets is very different from other people. But even right here, I adjusted the trend line a little bit to factor in a bit of those top areas right there, and we're still looking at the same thing. We're running into this trend line. We're consolidating below the 200-day moving average. Chances are we are going to pull back in the gold market pretty soon. So some of the dump is already setting in the pump and dump season, but right now we're on the dumping end. So we just have to wait and see. But I anticipate gold to pull back from that 200-day moving average. If not, it's going to be that trend line that does it in. Okay. As for silver, silver is able to break out so far and continue to go a little higher, but I have my own reasons for it being able to do that. I think the main reason kind of sits on that volume chart right there on the SLV, which is the iShares Silver Trust. And you guys can go and see it's breaking out a little bit. I'm still waiting for it to get around $34, on the silver chart, just because it'd be a very good exit area for me, personally speaking, on a professional basis. However, there is a possibility that it might not even happen, so I perhaps would want to wait until 32 instead. So we'll just have to wait and see how the silver plays out. I am trading the leveraged silver ETF. However, the main reason why I'm not using it in this video is mainly because of the fact that I don't have enough time to talk about it. So again, the main idea here though is to close your silver trade between these two trend lines. And chances are we're getting pretty close to that pretty soon. Moving on, let's go ahead and analyze Eastman Kodak. Eastman Kodak recently filed for bankruptcy. This stock has been on a really long-term downtrend. Volume seems to be continuously high, and it's above that moving average. And it is a 20-day moving average on that volume chart. Every time you get above it, chances are it's going to be either wild swing upwards or wild swing downwards. However, at this point, since the company has already filed for bankruptcy, even if you do get a dead cat bounce, don't be shooken by it. Chances are it's going to go all the way down to 3 to 4 cents per share. Okay, so 3 to 4 cents per share. Not, it's not going to fall 3 or 4%. It's going to fall down 3 to 4 pennies per share. So we're sitting at around 55 pennies right now. And chances are, if you were to short it and wait it out, even after it goes up and down and gyrates a little bit, eventually it's going to become worthless. I've seen this plenty of times. Every single time a Fortune 500 company ever filed for bankruptcy. This has been the case with Lehman Brothers, Bear Stearns, not really Bear Stearns because it got acquired, but Lehman Brothers, Washington Mutual, General Motors. I've seen it time and time again. And what typically happens is, again, stocks fall down, they get near worthless, and we even saw it, I think, in Borders as well, Borders bookstore. So just keep that in mind. This is one of those bankruptcy plays, and if you were to short now, it really wouldn't be too late because it would still fall all the way down to 4 to 3 cents, and you'd probably earn 90% return on investment. You'd only have to have the guts to put up with massive volatility after or post bankruptcy, because that's what happens in a lot of these penny stocks. They move up and down a lot before they eventually become worthless. Okay. Moving on, Deckers to Outdoors. Again, I'm not too convinced right here, and the main reason is because we're, I told you guys again before that, this is going to be your target exit zone between 95 and 85 between the gap areas. And this was most likely going to be the area that would be worthwhile because you have this area right here and this area right here are pretty congruent, $90. But even if you didn't close out at $90, there's only a $5 difference. Chances are it's still okay to close out. I recommended this trade, or thought it would be worthwhile, back at the very bottom over here, and it worked out pretty well actually. I wasn't able to participate in it, but it was able to bounce up as anticipated, and it continued going all the way up into that area zone. Right now we're at the bottom area of the zone, but again, we're in the dumping season where everybody starts to close out their positions towards the end of earnings season. So if it were me, I would just close out my position and wait for other trades to emerge. And I think the best one right now, again, if you have the patience and the guts for it, is to just short Eastman Kodak and wait until it eventually becomes worthless. Moving on, Bank of America continues to go higher, or not really higher today. I mean, they kind of float sideways today. But again, same thesis here. You know, it started out 720 on Thursday, gapped up a little bit, and then pulled back. Again, this is just typical market behavior. And I just want to review, you know, because all the time people get confused and they're like, oh, well, why isn't this working out this way? Or, you know, I mean, and you got to really tune out a lot of what happens on a daily basis. But what typically happens in a stock is that it likes to move in lockstep, a little bit higher, a little bit lower, and a little bit higher, and then a little bit lower. So what I'm trying to point out here is that you're going to see pullbacks, and then you're going to see it, you know, spurt up a bit, and then you're going to see it pull back, and then you're going to see it spurt up a little bit. And again, that's just typical market behavior. You have to be very patient with your investments, because if you're trying to buy on the margin of safety, which is what we're trying to do right now, and we're trying to push it all the way, you know, I mean, this stock is at a tangible book value of $14 per share. They've been doing a lot of cost cutting. They've done a lot to pull back their expenses so that they can become a more profitable bank, along with cutting headcount as well. So the way I see this is that eventually the company is going to generate cash flow, and the stock will eventually revert back to its tangible book value at the very least. Because again, we're buying in at a very large margin of safety of $7, unprecedented. There's, you know, you don't really see that. You're buying it at 50% of the book value of the company, or 50 pennies on the dollar. So again, that's, you know, why I'm primarily optimistic on Bank of America. Hey guys, and the final chart I want to analyze is AAMRQ, which is American Airlines. It went on to the gray sheets, which again are pink sheets, gray sheets, but it's basically over-the-counter bulletin board. And this is what typically happens after a company files for bankruptcy after being a multi-billion-dollar company. And it's trading at around 41 cents per share right now. Volume is, you know, dropping, and typically when a stock becomes worthless based on the fact that they're going to become bankrupt, falling volume implies that the stock will eventually trend lower. So that does it for me for today. If you guys have any questions, leave a comment right below.